I'm sure you're aware of the current housing situation in the UK. And to add salt to the wound, buy-to-let may be dying in 2023. I kid you not. As we've already seen, diminishing tax relief and high mortgage rates are killing the buy-to-let business, leaving property owners like you and me with no option but to either increase our rents, or some are selling in mass quantities. And that's usually happening for those people who own property in their own name rather than a limited company, because they don't want to go through all the rigmarole and the hassle and the headache that comes with incorporating a property portfolio. Now, in the good old days, when we calculated our tax liability, we had the luxury, and I call it luxury, of deducting our entire finance costs from our rental income prior to 2017. Between 2017 and 2020, that deduction was phased out. At the moment, presently, you may have to pay tax in certain circumstances, even if you are losing money, as you can only deduct a portion of your finance costs if you fall into a higher rate of tax. These changes in tax hit property owners very, very hard on their net profit margins. Now, subsequent to that, as you know, interest rates have gone up, making the overall problem of margins that much more frightening and difficult. Escalating mortgage rates. Moneyfacts, a data company, states that back in December 2022, the average 2-year fixed deal of a buy-to-let was 2.89%. Whereas right now, today, it is around a shocking 5%, give or take, depending on who you borrow the money from and what period and how much deposit you put down. To explain the significance of this rather big and hefty jump, a property owner taking out a loan for, let's say, £150,000 will be faced with a monthly interest charge of £625, which is a 73% jump. A whopping 365,000 buy-to-lets are expected to experience a loss by the end of 2023, according to research firm Capital Economics, as landlords refinance at higher rates after fixed mortgage deals are expiring or as they're buying new property. I say it's time for a mitigation plan, and I hope you agree. According to research by Hamptons Estate Agency, a typical high-rate taxpayer who owns property in the southeast will have an average mortgage expense of £9,601, assuming a rate of 5.14%, and taxable rental income of £11,680 if they refinance every 2 years. Their tax bill would be around £2,752. As a result, the property will make a net annual loss of £673. Not worth having, I say. Limited company property owners can still deduct their full mortgage interest costs from their income, and that is if you have a limited company. So you might want to think about incorporating your property portfolio, which has certain connotations, and I've got videos on this channel if you're interested in that. Despite releasing no cash, an owner may nevertheless pay capital gains tax and stamp duty, since in the eyes of the taxman, a transaction qualifies as both a sale and a purchase when you incorporate, unless you can claim Section 162 incorporation relief, and unless and until a partnership is incorporating to avoid a stamp duty land tax. Now, there are ways to eliminate this, but you've got to speak to a property tax accountant or a specialist, someone like me, of course. Now, let's suppose our good buddy Dave moved his property portfolio, which he owns as a partnership with his spouse, into a limited company. Now, this strategy, when they incorporate, is going to save them a significant amount of stamp duty, because they're not going to pay any, because they bought it as a partnership if it was a proper partnership, and they won't pay capital gains tax if they qualify for Section 162 incorporation relief if a property business incorporates. Unfortunately, the flaw in the plan is that they're going to have to refinance, and the cost might be higher. And if that is the case, then you've got to do the maths and the numbers to make sure that everything ties up. Now, the good thing, of course, is that capital gains tax won't be payable, but it's rolled up into the shares, and you have a rebasing of your properties, therefore you'll pay less capital gains tax in the future. And because they're paying more interest, they've got to do the maths to make sure the whole thing works for them. Now, Dave's arrived at the conclusion that he must sell a proportion of his property, which is going to reduce his overall property portfolio, which is quite obvious by the way, because he doesn't want to incorporate. And a series of unfortunate events. If a property owner does not sell, their only option is to obviously refinance or pay the properties off. As they refinance, because they need the cash, then they've got to pay more tax because they can't claim all of the interest for tax purposes. And then of course the other flip side is the interest covering ratio for funding has to work as well. So as rates go up, that's going to make that tighter. So Dave's got that particular problem. And then the rental income, depending on which lender you speak to, has to be around 125%. So he's got that particular challenge if that is what he's looking to do in terms of refinancing. If you're a high rate taxpayer, the interest cover is 145% and not 125%. Now what this translates to is that when mortgage rates rise, a property owner will need to increase the rent if they want to refinance. Sounds common sense, but not everybody does that, and you've got to make sure you look at the numbers to make sure that you're not losing money every single month and year because we're in property for a particular reason. Nevertheless, there is a limit, a ceiling on what you can charge, and that's what you need to work out in terms of looking at what the market is saying. Now, as you know, the market is already starting to come down as most tenants are unable to afford higher rents. There's a cost of living crisis, which we all know about. Salaries aren't catching up with inflation and increases, and it's all becoming very, very difficult. Now, in May last year, the average rent growth on a newly let property reached a record high of 11.5%, according to data set from Hamptons, which dated back from 2012 onwards. Now, while it's slowed down to 7.9% as of November 2022, it is still quite high as double the levels of 2019, so just before COVID. Now, these high levels will continue to affect the average rents across the board, as I see it, because costs are going up. If you're paying more when you refinance, then you're going to have to increase rents, otherwise you're making a loss every single year. Why would you want to keep those properties then? The average rent in the rental sector as a whole, and not just the newer let properties, tends to move slower, and it's taken a leap of 4% since November on a year-to-year basis. Now, since the Office for National Statistics started collecting their data back in 2016, this rate was the highest on record. Now, as we all know, tenant budgets are already stretched and they're very, very thin. There's not much margin there, and it's becoming very, very difficult. So increasing rents is going to have a huge toll on your tenants, which means they may have to vacate. Now, as if that wasn't enough, property owners are feeling that regulatory burden tightening around their necks. A lot of future government plans are going to make their lives harder, make no mistake about that. And property owners would also likely incur additional costs of up to £10,000 per home to fund work due to impending proposals to require landlords to upgrade all privately rented buildings to a minimum energy performance certificate rating of band C by 2028. That's quite a horrifying picture I have painted, but it's based on facts, and the housing market is not that sturdy. So always remember to not keep all your eggs in one basket. And with that said, I must get going. See you around, and remember to leave a comment below on what you wish to know next, and share your thoughts on what you think is going to happen to the property market.